Hi, in this lesson, we shall talk something about the process of IPO, FPO, and something about their pricing. You may be broadly aware as to what an IPO or an FPO is, but my request is do not skip this lesson. Try to go through it and understand it conceptually. You may find it very simple, even childish, but that is how the concepts are explained, and it is always good to understand the concepts. So, if you recollect, in the previous lesson, we have seen that the promoters could manage to pool in $10 million. $2 million they borrowed from the bank, and they were still short of $8 million to start their business, and therefore they invited that money from the public. They asked the public to contribute and become a stakeholder in the business. All right. So this offer of shares which the promoters made to the public, inviting them, asking them to become a stakeholder in their business, that process is called as the IPO, or the initial public offer. Why initial? Because this offer is being made by the promoters of this company for the first time. For the first time, they are inviting the public to become a stakeholder. Therefore, it is the initial public offer. And this process of offering the shares to the public is called as the public issue of shares. The event is called as the initial public offer, and the process is called as the public issue of shares. Now the question is, why are the promoters offering the shares to the public at the same price of $10 per share, the same price at which they themselves are taking the shares? The answer is that in the beginning, when the company is yet to establish itself, when the company is yet to begin its business, at that time, the promoters and the public are on the same footing. The business has not yet commenced. We do not know how the business will perform, what is the future course of action. So therefore, the public and the promoters contribute in the same manner, the same amount per share. All right. So in the beginning, when the company is yet to begin its business, the worth of the company is $18 million in terms of equity, divided into 1.8 million shares of $10 each. All right. It could be $10, it could be $1, it could be $2. Accordingly, they can have the face value and the number of shares. All right. Out of this 1.8 million, 1 million shares are held by the promoters because they have contributed $10 million, and the remaining 0.8 million is held by the public. So 8 million will be contributed by the public. And 2 million, of course, is the debt taken from the bank. Clear so far? Alright. Now, let us imagine a situation. Just hypothetically consider that the promoters pool in $10 million, alright. 2 million they borrow from the bank, that is also okay. And let us say that they start their business with $12 million without taking any contribution from the public. Alright, so they are not coming out with a public issue, no IPO at this stage. With a lesser amount, with $12 million, they start their business on a lower scale probably. Maybe they will purchase a few less machines, maybe they will hire a few less number of people, maybe they will have little less land. But with $12 million, they start their business. So to begin with, the worth of the company is 10 million in terms of equity, and this entire equity belongs to the promoters. 2 million in the form of debt. Alright? No shareholding by the public. So far, the public have not come in. All right. And over the next 5 years, this company generates a lot of profit. And every year, a small amount of profit the promoters take for themselves as dividend, and a major portion of the profit they reinvest in the company for the growth of the company. All right. So whatever profit they make, a small amount they share among themselves as dividend, and a large amount of that profit they reinvest back into the company. And that is how, over the period of 5 years, the worth of the company increases. Initially, what they had contributed as 10 million, over a period of 5 years, that 10 million becomes 25 million. Let us say, all right, it becomes 25 million. And of course, the 2 million of debt which they had taken continues. Every year they are paying an interest on that debt. All right. So therefore, the shares which were initially valued at $10 per share, the face value, their face value still remains $10, but their worth in the books become $25. All right, because this 10 million have become 25 million. So the share which was worth $10 in the beginning now has become worth $25 in the books. In the books means in the books of accounts, in the balance sheet. The market value may be different, but on paper, in the books, that share has now become $25. The face value remains 10, but its actual worth becomes 25 on paper. All right. Now the company wants more funds for their expansion plans. The company wants to increase their manufacturing capacity and export the garments to the other countries. So far, they were making or manufacturing garments for the local requirement. Now they want to increase the capacity and export the garments. All right. So what will the company do now? They require more funds. 25 million they already have, but they require more funds. So now, at this stage, let us say the company wants to go public. They want to come up with an initial public offer for the public. They want to offer shares to the public. 1 million shares they are already holding at $10 each. Now they want to offer additional 0.8 million shares to the public at this stage. All right. Now remember, the face value of the new shares will remain the same, $10 per share, because it is the equity. Equity means everybody holding the share is equal as far as the company is concerned. One share, one vote. All right. So whether it is the promoters who had taken the shares earlier or the new public which is now entering, all are at the same footing. So therefore, the face value of the new shares will also remain $10 per share. But the question is, will the company offer the shares to the public at the same initial price? Face value will be $10, alright. But will the offer price be the same? For the past 5 years, the promoters have been working hard. They have been slogging to establish the company. Now the company has been established. It is doing good. All the hurdles are cleared. So would the promoters want the new public to enter at the same initial price? Certainly not. They would not offer the shares to the public at the same price of $10 per share, though the face value will still remain 10. So what they will do, the company will offer the shares to the public through the initial public offer at a face value of $10 plus some premium, some additional amount for various reasons. And what are those reasons? What will this premium depend upon? The premium will depend upon several factors. The first and the foremost thing is the difference between the book value. The initial investment by the promoters, which was $10 per share, In the books, it has become $15 per share. Alright? The face value is 10 itself, but 15 is the additional growth which has taken place. So therefore, first of all, the promoters would want the public to pay that difference. So $15 per share is because of the book value they'll pay additional. Apart from that, the business is already up and running. There is a lot of confidence in the business. When the business initially started, there were a lot of question marks. All those question marks are eliminated. The business is well established now because of the hard work of the promoters. So would the promoters not want the public to pay for the hard work which has already been put in? Certainly. So let us say they ask for additional $10 for the confidence in the business. Then the business is already having a loyal clientele. They already have customers. Less effort will be required now. Less struggle will be required now for marketing and making a niche for themselves. So for that already available loyal clientele, the premium would be, let us say, $10 per share. This the company would want to get from the new entrants. All right. What we are talking, these values, they are all hypothetical at the moment what we are discussing. It is not decided at random. Quite a complex process. It is decided, the premium is decided by the lead managers to the issue who are expert in this field. But just for the sake of understanding, we are taking these hypothetical figures. Alright? Okay. Now, apart from the loyal clientele which the company already has, the company is now wanting to export the garments. So far they were making for the local customers. Now they want to make it for export. So the export modalities have been worked out and there is a lot of scope for huge profit in export. And for all this, the promoters have done the hard work. So therefore, the promoters would want some premium for that also. Now let us say $15 as premium for this particular aspect. And then the company has established itself as a known brand. People in the market know the company by its brand name. So the company has a brand value. And for that brand value, let us say the company is asking for a premium of $20 per share. So there can be few more things which may come up to your mind or which may come up to the promoter's mind. But the fact is that the offer price now, the offer price will comprise of the face value plus some premium. And what we have hypothetically worked out here is $68 per share as premium. So the offer price in the IPO will be, let us say, $78 per share, comprising $10 as the face value and $68 as the premium. Alright. Now let us see what the worth of the company is after the IPO. So first of all, if we consider the IPO, we have seen that 0.8 million shares have been offered to the public and the face value of those shares is $10 per share. So 8 million has come in the form of equity. And then the same amount of shares, 0.8 million shares, have also attracted a premium of $68 per share. So $54.4 million have come in the form of premium. Alright, all this will now go into the company's balance sheet. How? Let us try and understand this. Let us try and understand the equity, reserves and surplus under that. You already know what the equity is. We have discussed the amount, face value of the shares contributed by the promoters as well as the public. That is the equity. Then what is the reserves and surplus? See, this reserves and surplus I have already explained in one of my other courses, which is about understanding the financial statements. But notwithstanding that, let me explain to you in very brief. See, every year the company earns some profit. Out of that net profit, any good company will not give away the entire profit as dividend. A small amount they would distribute as dividend, and the remaining amount they will reinvest into the company for expanding the business or for the growth of the business. And that money which gets reinvested goes under the head of reserves and surplus. And secondly, when the company, offers shares at premium, this premium amount would also go as reserves and surplus. So ultimately, the equity and the reserves and surplus, this entire amount belongs to the shareholders. All right. Earlier, before the IPO, the amount belonged only to the promoters. Now, after the IPO, this entire amount, equity plus reserves and surplus, belongs to the entire spectrum of shareholders, the promoters as well as the public. All right. And debt, you already know what has been borrowed from the bank or other institutions, that is the debt. All right. So now let us see the worth of the company. In the beginning, when the company started, that time the equity was 10 million, pooled in by the promoters. We know that. And there were no reserves and surplus because the company had just started. There were no profits, so reserve and surplus were nil. And 2 million, of course, was the debt. Then just before the IPO, if you recollect, 10 million was the equity of the promoters and 15 million was the reserves and surplus. You remember I had said that 10 million has grown into 25 million. So the equity remained as 10 million and that growth of 15 million comes into the reserves and surplus. And 2 million, of course, the debt remains. Then just after the IPO, now after the IPO, we know that 10 million was already there of the promoters. 8 million in the form of equity has now come in from the public, this 0.8 million shares, all right? So that makes an equity of $18 million. So the new equity of the company is $18 million. And the reserves and surplus, we already know that 15 million was the reserves and surplus before the IPO. 54.4 million has come in the form of premium, so that goes in as reserves and surplus. So the total reserves and surplus becomes 69.4 million. Now this entire amount, 18 million plus 69.4 million, this entire amount belongs to the shareholders. Shareholders means the promoters and the public together. This is the entitlement of the entire shareholders. All shareholders have equal stake on this amount. Got the point? And of course, the 2 million debt which the company had taken, that remains. Now, the question which you may ask me is that why should you know all this? What is the point in understanding all these intricacies of the IPO? The answer is that for a comprehensive understanding of the stock market, you need to know all this. Only if you understand these concepts, you will be able to understand how the stock market functions. Stock market does not only mean buying and selling shares based on tips from somebody. You have to know the intricacies and the entire process of how things function. All right. So now this is just a portion of the IPO what we have discussed. We shall continue this in the next lesson where we shall talk about the FPO and also about the pricing of IPO and FPO. All right.